Alright folks, my presentation today is for educational purposes only. It does not constitute any legal advice or opinion. So please do not use any of its contents without seeking a professional advice. I will be talking about excess credit and excess limit today. So after computation of creditable foreign income taxes, our next step is to compute foreign tax credit limitation. Let's take an example. In this example, we have a USA corporation that has US source income of 200, foreign source taxable income of 100. Total worldwide taxable income is 300. Assume foreign tax rate is 45%, and let us assume USA tax rate is 35%. Let's take a scenario that credit is limited. So foreign tax credit is limited to the United States tax on foreign source income, which is 100 times 35% equals 35. Total tax on USA corporation taxable income is 300 times 0.35, which is 35%, equals to 105. This is how the foreign tax return would look. Taxable income is 100, foreign tax rate is 45%, foreign tax is 45. This is how USA tax return will look. Taxable income is 300, US tax rate is 35%, pre-credit USA tax is 105, foreign tax credit is 35. So US tax payable would be 105 minus 35. The balance would be $70. Next example, let's take no limitation. So foreign tax return would be taxable income is 100, foreign tax rate is 45%, foreign tax is 100 times 0.45, which is 45%, equals 45. US tax return would look like this. Taxable income is 300, US tax rate is 35%, pre-credit tax is equal to 105, foreign tax credit is 45. So the balance US tax payable would be 105 minus 45 equals to 60. Exemption. An individual with $300 or less of creditable foreign income taxes may elect to be exempt from the foreign tax credit limitation, provided he or she has no foreign source income other than passive investment income. The $300 amount is increased to $600 in the case of married persons filing a joint return. Relative tax rate. The relation of US tax rate and foreign tax rate is a major determinant of whether a taxpayer is in excess limitation or an excess credit position. Taxpayers will be in an excess limitation position when the foreign tax rate on a taxpayer foreign source taxable income is lower than the US tax rate, and in an excess credit position when the foreign tax rate is higher than the US tax rate. So let us take an example. We have a USA corporation that has foreign taxable income of 100. US source taxable income is 0, and let us assume USA tax rate is 35%. Let's take case number 1. Foreign tax rate is 30%. This is how foreign tax return would look. Taxable income is 100, foreign income tax rate is 30%. Foreign income tax would be 100 times 30% equals 30. US tax return would look like this. Taxable income is 100, US tax rate is 35%, US tax would be 35, less foreign tax credit, which is $30. So balance US tax payable would be 35 minus 30 equals to 5. Let's take case 2, where foreign tax rate is 40%. Foreign tax return would look like this. Taxable income is 100, foreign income tax rate is 40%, Foreign income tax is 100 multiply 40% equals 40. This is how USA tax return would look. Taxable income is 100. US tax rate is 35%. Pre-credit tax is 35. Foreign tax credit is 35. So balance US tax payable would be 35 minus 35 equals to 0. Folks, all this information comes from the book Practical Guide to US Taxation of International Transactions, 9th edition, written by Robert J. Missy Jr. and Michael S. Shadewald. Publishers are Walter Kluwer CCH Incorporated. Folks, my name is Mansoor Sohail. I'm a tax consultant and I prepare taxes for Canada and USA. I'm operating out of Toronto. You may call me at 416-283-8774 if you do have any question, or email me at taxservicesguru@gmail.com. Thank you for listening.